All right, a quick follow-up thought on cash balances. Remember in video 53, we introduced the idea of how to think about cash balances in a little bit more sophisticated way than what the financial planning industry typically programs us with. And there's a really funny, sort of unintentionally funny joke from Cisco back in its sort of boom days in the late 90s, early 2000s. Back then, the CEO was John Chambers, famous CEO from the technology era. And one day on one of their conference calls, it was a quarterly conference call, and an analyst asked Chambers, because at that point, the Cisco had been doing very, very well and had been building up a larger and larger cash balance quarter after quarter. And this one analyst had the temerity to ask, what is the proper cash balance for a company like Cisco? And John Chambers answered with one word. He said, more. And then they went on to the next question. It's really, really funny and unintentionally so, but basically it sort of gives you an idea of why cash is like ammunition. And again, novice investors, retail investors, they tend to think about this in a much more narrow way where they need to have their money working for them. And I get that. I mean, if you have a limited amount of capital, you got to have more of it, relatively speaking, earning you some kind of return. But once you sort of get into a stage of sophistication and a level of capital where you're not so worried about, scraping every last interest, penny of interest out of your cash balance, you actually can start thinking a little bit more big picture about uncertainties that the future might bring you, and both positive and negative uncertainties. The more cash you have, the more weaponry you have to maybe make a speculative investment, as we discussed in video 53. And you can endure any kind of negative or adverse scenario. So more, that's how much cash to carry. As always, thanks for watching.